So thank you and welcome to our today's session. So today we want to look at accounting changes and errors correction. So this is normally guided by the International Financial Reporting Standard number 8. So the expected outcome after this session will be one, you need to be able to identify the type of accounting changes. You need to describe the accounting for changes in accounting principle, understand how to account for retrospective accounting changes, understand how to account for impractical changes, describe the accounting for changes in estimate, identify changes in a reporting entity, describe the accounting for correction of errors, identify economic motives for changing accounting methods, and finally, you need to be able to analyze the effect of errors. So that's what we are going to discuss today. Now, in an overview, so the accounting changes, we look at changes in accounting principle, changes in accounting estimate, changes in reporting entity, correction of errors, and you're also going to look at the motivation of change of the method. In terms of analysis, we are going to look at balance sheet errors, income statement errors, balance sheet and income statement effect, and finally preparation of statements with error correction. Now, as part of the introduction, accounting changes refer to alteration in method estimate or entities used in the preparation of financial statement. So the changes, as I have said, they are normally guided by the framework IAS number 8. Sorry, not FRS, it is IAS. So as I have mentioned earlier, there are three main types of accounting changes. One, it is change in accounting principle. Second one is change in accounting estimate. The other one is change in reporting entity. And each type is treated differently in terms of disclosure and financial statement adjustments. Now, let us look at the changes in accounting principle. A change in accounting principle involves switching from one generally accepted accounting principle, that is GAAP, to another. For example, we can have a company changing how they do value the inventory from first in, first out to weighted average method, or we can also have maybe the company switching from first in, first out to last in, last out, or maybe switching among the three methods. And the reason as to why the company can switch among the various methods, it can be either because of a regulatory change, it can also be because of smoothening or aligning with industry, or it can be for the reliability. As we are going to see, if for example use first in, first out, and I believe that we have covered the cost accounting, we know the advantages and the disadvantages of FIFO, we know advantages and disadvantages of FIFO, we know the advantages and disadvantages of weighted average method. So if a company wants to have or to improve reliability and relevance, they can choose the method that best suit them on various parameters. Now, how do we approach? The approach for reporting, so there are three approaches for the estimate. One, you can use current approach, you can use a retrospective approach, or you can use prospective approach. So the current approach It is whereby you change the change is effected in the current period. So, like now, we are in which period? We are in period 6 of year 2025. So, if there happen to be a change, you can change it in any of this period for the year 2025. That's what we call current. Retrospective, it is backward. So you have to open 2024 and do some changes in that year. For International Financial Reporting Standard 1, it advocates for comparability. So when you are reporting financial statement, you should report them in a quorum form. So for example, you should compare 2024 with 2023, 2024 and 2025. Yeah, but now when it comes to the retrospective, in some cases, it add up to a restatement position. Restatement mean you need to restate the balances that are brought forward from previous period. And when this happen, in most cases, you find that the balance sheet is reported in a 3 column, but the P&L may be reported in 2 column, but the restated balance in the balance sheet are normally reported in 3 column because the change normally happens in the retained earning. Then we have the prospective, that is in future. So the change can be changed in future. Yeah, you can change it in future as opposed to current or retrospective. But now the choice of the approach actually is dependent on the materiality of the amount that is involved. So current, this is the one that I just talked about. It is immediate. For example, in 2025, a company discovered it had the estimated rent expense by Kenya shillings 50,000 for January 2025. So this one can be recognized immediately. So if, for example, you realize there is an error, yeah, in 2025, just recognize that error immediately as you realize it. And now, sorry, you need to pass the relevant double entry, yeah, because you had underestimated rent expense, so you need now to recognize that rent expense. So you debit the profit and loss account by 50,000, then you credit the accrued expense, which is the balance sheet. That way, you have collected the understated expense because you either omitted or you recorded the amount wrongly. Then we have the retrospective. Now, for the retrospective, as I have said, this one is for the past period. So the past financial statements are restated as if the new method or collection has always been applied. So for example, if you are talking about changing the accounting principle from FIFO to weighted average, so in this case, what you need to do actually, if for example it's an asset, you look at the inventory, you need to look at when was this inventory bought, and then you revalue that particular inventory using now the other method. If for example you had used FIFO and you want to use weighted average, you now assume it was valued using the weighted average. So the difference between the two methods, the difference that you are going to get, the valuation using FIFO and the valuation using LIFO, the difference is expensed. But in most cases, because those periods have already been crossed, you might take it to the retained earning. So that is what normally happens. An example, in 2024, valuing of inventory using FIFO, the inventory was worth 1 million. Using weighted average, the inventory would have been 950. That means this inventory has already been overvalued because FIFO it is 1 million. Using this other method, weighted average, it is 950. So if you want to use 950, then it means you have to reduce your inventory by 50,000. And this is how you are going to do it. You debit the retained earning 50,000 and you credit the inventory 50,000. Remember the double entry concept where we normally say increase in asset you debit, decrease in asset you credit. So in this case, the inventory is an asset and it has decreased from 1 million to 950. So it has decreased by 50. So that 50 is the one that you are going to credit. And then the other entry goes to the retained earning. Otherwise, it could have gone to P&L, but remember everything from for P&L, from P&L perspective, normally comes to the retained earning. And that is why we normally say the profit and loss, it is as at, it is for the period, and for the balance sheet, it is as at. As at means since the time the company started. So prospective, the change is applied for the current period going forward. So for prospective, if there's an error, like now, if for that case of the stock, if you are using the prospective, you could not have gone back to other period. You could have just changed the current period, and now going forward, we adopt that particular new valuation method. So that is a change in principle. Now let us go to the next one, which is a change in estimate. A change in estimate. So a change in accounting estimate arises from new information or new development that affect current judgment about future event. Example include changes in useful life of an asset, depreciation method, or bad debt provision. So this is to say, for example, an asset, let's say a motor vehicle. A motor vehicle, as a rule of thumb, it is known to have a depreciation of 5 years. So within 5 years, that asset is fully depreciated and its net book value is zero. If for any reason that motor vehicle has been devalued and this for life has increased, maybe from 5 years to 7 years, this is the what we are talking about. The depreciation will change, um, and if there was an aspect of the salvage value will change. So we'll see in our next slide how we should treat this. But even before we see how we can treat this, we can just give an example of item which require estimate. One, we have uncollectible receivable. These are the bad debts. The other one is inventory obsolescence. These are the inventory that either they have been passed by time due to technology or for some other reasons they are no longer required in the market. The useful life and the salvage value of the asset. The useful life is now the number of years that asset is supposed to generate revenue for the organization, and the salvage value is if the asset has fully depreciated, how much can we sell um, this asset, this motor vehicle? And that's what we call the salvage value. Then we have the periodic benefit by the deferred cost, liability of warranty cost and income taxes, recoverability of mineral resource, change in depreciation method. For example, you can change the depreciation method from reducing balance to straight line or other methods. An example, the asset, we have an asset here. The asset cost is 500,000. The accumulated depreciation is for 5 years is 250. The net book value in 2025 was 250. The original useful life is 10 years. So the new estimated remaining useful life is 3 years. So the asset has increased the useful life by 3 years. So how are you going to account for this change? Let's see. So now the net book value before the change, the net book value is actually at the point of change. The net book value is 250. That's the net book value. Then you divide by 3 to get what will be the depreciation per year, and you get this amount here. Higher. Then we have another example here. Arcadia High School purchased equipment for 510, which was estimated to have a useful life of 10 years with a salvage value of 10,000 at the end of that time. Depreciation has been recorded for 7 years on a straight-line basis. So in 2008, that is year 8, it is determined that the total estimated life should be 15 years with a salvage value of 5,000 at the end of that time required. What is a journal entry to collect prior year depreciation expense? 2. Calculate depreciation expenses. Again, this is very simple. Number 1, you have to determine the net book value. You have to determine now at the point of change, what's the net book value? So the equipment cost was 510. You need to less the salvage value. So the depreciable base is 500. Useful life is 10 years. That is the original useful life. Annual depreciation. So how long has it depreciated? So we'll have annual depreciation is 50,000, and it has depreciated for 7 years. So you multiply by 7 years to get there in 50. So in this case, you realize that the net book value will be 510 minus 350 to get to 160. So 160 is the net book value after 7 years. Now, the next step is now to get the depreciation after the change. So the net book value is 160, less the salvage value, the new now salvage value, get the depreciable base of 155. The useful life is 8 years, and therefore the annual depreciation will be 19,000. In this case, you need to debit the depreciation expense by 19,375 and credit the accumulated depreciation with the same amount. That is how we go about it. So change in a reporting entity. Now this one involves, for example, if you have been reporting as a single entity, now you have consolidated. You are a group of company, yeah, like now Equity Bank, yeah. So initially it was just Equity Bank. Then we had the requirement by the Central Bank of Kenya, which said that all the banks should have, especially those who are listed, they should have a holding company that should do other businesses, and then the bank should be left to do the bank. So if Equity Bank is now reporting the financials, it report as a consolidated entity. So that is what we talk about the change in reporting. Initially, it was just one entity. Then we have 2 entities, 3 entities, 4 entities. So all these entities now they combine and they report their revenue or other activities as consolidated figure. Now, there are some few disclosures that you need to make. So now, if, for example, you have made any change, you need to make the disclosure in terms of the nature of the change. Is it a change in principle? Is it a change in estimate? Or is it a change in the reporting entity? Then you need to give a reason for the change. Why did you make a change? Is it because of a regulatory requirement? For example, we have FRS 9. There was a change from IAS 39 to FRS 9. There was a change from IAS 17 to FRS 16. Is it because of a change in the reporting framework, or is it because the regulator has forced you to do the change? So you must disclose the change. Then the impact, especially where material, like the way we have seen before changing from FIFO to weighted average, you have to show the 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 impact of the change. Then about whether comparative figures have been restated, you should also show the effect in terms of the comparative figures. Then we have the correction of errors. So there are four main causes of error. One, we normally call it a mathematical mistake. This is incorrect addition or subtraction in the ledger. For example, you can say 1 plus 5 is equals to 6. Yeah. Someone else can say 1 plus 5 is equals to 7. That is incorrect. The other one is misapplication of accounting principle. For example, capitalizing expense instead of expensing. Let's say, for example, there is an advertising cost. Instead of expensing the advertising cost, you capitalize it in the fixed asset and maybe even start amortizing it. The other one is oversight or misuse of facts. No recording accrued expense. So this is, you may, for example, have paid salaries, but you are not accrued. You have totally omitted it. The other one is fraud or misstatement. This is intentional revenue overstatement. You can decide you want to get the bonus by fire, by force by fire, and therefore you overstate the revenue so that you can earn bonuses. So again, that is an error, and it is unethical for that matter. Now, how do you correct these errors? If the error are material, you need to restate the prior financial statement. You need to restate the prior financial statement. Now, if it is immaterial, you can correct it in the current period and make the necessary disclosure. Now, for mathematical mistake example, in 2023, while totaling purchases, the accountant incorrectly added all this. Yeah. This it is, if you add this, you're going to get 340, but the accountant recorded this as 300 due to summing error. Yeah. But the good thing is that I'm very sure none of my students will do this. Then, how are you going to correct this? You're supposed to record 340, but you have recorded 300. So that means you have understated purchases by 40,000. So in this case, what you need to do, you need to debit the retained earning, then you credit the purchases. Again, remember the double entry concept, the one I have just talked about, that increase in asset you debit, decrease in asset you credit. This is a liability. We had recorded a raw value of liability. So instead of recording 300,000, we record, 340, we recorded 300. So increase in liability, we credit. So the liability, we increase them by 40,000, and the other leg go to the retained earning. Okay, moving on. Misapplication of accounting policy. For example, we have this quack accountant who capitalized advertised expenses of 200,000. To correct this one, yeah, you need to reduce the asset because you had assumed that the advertising expense, they are asset. So you need to credit the intangible asset and then debit the retained earnings. Oversight or misuse of facts. Now, the company here failed to accrue salary amounting to 150. They failed to accrue. So in this case, it means that the expenses were undercasted. So what you do, you need to increase the accrual. Again, this is a liability. Increase in liability you credit. You need to credit the accrued expense, and then you debit the retained earning. Remember, this debit of retained earning, if it were a normal accounting without the restatement, you could be debiting the P&L. Fraud. Yeah. So we have the sales manager here who inflated the sales revenue by 500,000 through fictitious invoices to meet performance target. and earn the bonus. So now this, if the revenue was inflated, which entries are we going to pass? Again, remember revenue, we normally touch on receivables or customers. So customers are going to decrease because you are going to reverse that inflated sales. Yeah. Remember, when you are passing entry for sale, you normally debit the receivable, especially when you are selling on credit, and then you credit the sales in the P&L. So now, in this case, you want to pass the credit notes. So the receivables are going to decrease because they are assets. That's why we are crediting the receivable, and then the other leg definitely goes to the retained earning. All right. So this is just a summary table of basically what happens with those changes. You'll be able to look at it at your own time. Then we have the disclosure requirement. Again, you need to disclose the nature of the prior period error. So we have said there are those 4 errors. So first of all, you need to classify, is it a mathematical mistake? Is it a misuse of facts? Is it fraud? Or what is it? So you have to disclose the nature of the error. Then amount of the correction for each prior period. So you need to disclose the amount. Effect on the basic and diluted earning per share. Effect if retrospective restatement is impractical, explain why. So those are the 4 disclosures that you're supposed to make in this case. So there was a question here. So this question is in the form of an assignment. I'll post it, you try it, and then if you don't get it, we can do Torvalds. Although I have done the workings somewhere, the workings are still here. So that's when you are going to look at it at your own time. And that is what I even told the physical class, because it's just a repetition of what we have just discussed. But this one is the form in which you expect a question for this topic to come through. So make sure you look at this particular question, because it can assist you in revising for the exam. The exam normally comes in that format. So now let us look at the motivation for changes in accounting method. Why should a company change an accounting method? Why should a company move from straight line to reducing balance method for depreciation, or reducing balance method for depreciation to straight line? What motivates this company to do the change? Why should the company change from LIFO to FIFO or to weighted average? Why should a company change from IAS at 9 to FRS 9? Why should a company change from FRS 17 to, IAS 16 to FRS 17? So one, it is improved relevancy and liability. So you want to report, like there we have seen the inventory. In one method, it is 1 million. In another method, it is 950. And the accountant, you know very well, you're supposed to be prudent and you're supposed to be conservative. So you always assume the worst case scenario. So if you're given the valuation of 1 million and 950, as a conservative accountant, you need to take 950. The other one is compliance with the new accounting standard. For example, those changes from IAS at 9 to FRS 9 for the impairment of the receivable. That is, you want to comply, and especially the regulated entity in banks and in insurance and in other sector, they are required by the regulator, either CMA, central bank, the insurance regulatory authority, or other regulatory body, to comply strictly with the new reporting standard requirements. The other one is alignment with the industry practice or peers. So if, for example, you're in the banking sector, you need uniformity in terms of the reporting. In terms of valuation of various assets, various liability, you need to have a proper uniformity. Then the other one is business restructuring or operational changes. Like the way we have said, you can have a changes in the reporting entity. So a company is changing from being a single entity to a consolidated entity. The other one is internal reporting and management use. So you want to have, as managers, you want to have a valuation method uh, which represent the true fair view state of the company affair. The other one is mergers, acquisition, and consolidation, which almost agree with business restructuring and operational changes. So in terms of error analysis, there are some few questions that you need to ask yourself. What type of error is involved? What entries are needed to correct for the error? After discovery of the error, how are financial statements going to be restated? So those are critical errors or critical questions that you need to ask yourself when you are doing error analysis. Okay. So balance sheet errors. So there are two types of balance sheet errors. One, it is called counterbalancing error, and the other one is non-counterbalancing error. So for the counterbalancing error, this one corrects itself in the subsequent period. And for the non-counterbalancing error, this one do not correct itself, and it has to be corrected by someone through passing of an entry. Example, a partial trial balance of Dixon Corporation is as follows on December 31st, 2010. Supplies on hand 2,500, accrued salaries and wages 1,500, interest receivable 5,100, prepaid insurance 90,000, unearned rent 0, accrued interest payable 15,000. Instruction: assuming that the book have not been closed, what are the adjusting entries necessary as at December 31st? 1. The physical count of supplies on hand on December 31st, 2010 totaled to 1,100. So the accountant had recorded 1,100. Yeah, that is supply of on hand 1,100, 2,500. But the actual one is 1,100. So that means the supplies on hand were overcasted by 2,500 minus 1,400. I mean, 2,500 minus 1,100, so you get 1,400. And therefore, you need to reduce the supplies on hand by 1,400. And supplies on hand are assets. So you credit the supplies on hand, then you debit the supply expense. The other one, accrued wages and salaries on December 31st, 2010, amounted to 4,400. 4,400. So again, in this case, here, accrued salaries and wages, we had said it is 1,500. But here, we have seen it is 44. Again, we had undercasted salaries and wages by 2,900. So you debit salaries and wages 2,900, credit accrued salaries and wages 2,900. Then the other one, accrued interest on investment amounts to 4,350 on December 31st, 2010. Accrued interest on investment. So how much was it here? Here, the interest was 5,100. And here, we are told it's supposed to be 43. So, accrued interest on investment, so it was 43. So we had over accrued. So we reduced the interest expense, interest revenue, you reduce by 750. Interest receivable, you reduce it by again 750. The other one, the unexpired portion of the insurance policy totaled to 65,000 as of December 31st, 2010. The unexpired portion of the insurance policy totaled to that. So what was it here? it was 90,000. But here we are told it's supposed to be 65. That means you need to reduce it. You need to reduce the unexpired insurance policy. So prepaid insurance is an asset. So you debit asset. I mean, you credit the asset because it is reducing. Then the other leg, you debit the interest expense. 24,000 was received on January 1, 2010 for rent of a building for both 2010 and 2011. The entire amount was credited to the rental income. So how much was rental income here? It was zero. It was zero. So rental income, here you have to debit the rental income and credit the unearned rent. Depreciation for the year yeah, depreciation for the year was erroneously recorded as 55,000 rather than the correct figure of 50. So this one will be a retrospective application. So you need to debit the retained earning and then you credit the accumulated depreciation. And because the reason why you're debiting the retained earning, the amount is material first, and then you have to open the prior period. So that is how the analysis are done, and I've given you the two main questions. So this question where you are given this trial balance, where you are given this trial balance, and you are told to analyze how you are going to correct those errors. It's a very common question in an exam, and the one that I have just shown you on the assignment, this assignment, again, it's a very critical question when it comes to exam. Yeah, so these are they are not tough concept, they are very simple concept, but you need to do more revision. So do you have any question, comment, or feedback? Please unmute and say something. Anyone with a comment?
Should we focus more on the theory side or the practical calculation side?
Yeah, I've just shown you the link where the exam, the link, the exam, I mean the areas which are very common with the exam. Yeah, so those two calculations, they are very common in the exam. But it's always good to read everything for your understanding. Yeah.